Let's talk about the structures that affluent Aussies often use. Now, what we've got here is a bond, so not a fixed interest bond, but either an investment or education bond. And the reason why we sometimes incorporate this is the bond is taxed at 30% internally, so at the company tax rate or maximum of 30%, it can be lower. And the returns are capital gains tax free after 10 years. So it can be a good structure to use if, say, you're not setting up a trust. And you might not need to set up a trust if you don't have enough beneficiaries to split to make it worthwhile from a tax perspective. Because another consideration here is around fees. We're not going to set up a trust if there's no tax or asset protection benefits, because we're still going to have to pay, probably around about $3,000 or $4,000 a year in accounting fees to sort of do the returns for the trust. So it's only if it's worthwhile. So sometimes instead we'll have a bond structure. Now, sometimes we'll have both though, and the reason being is that education expenses, so private schooling as an example, can often offset some of the earnings, or it gets a tax gross up. So often we'll have both for high income families who are also sending their kids to private school. Then you've got a company here, so for certain clients who run their own business, they'll also have a company. And often the shares are owned by the trust as well. So that's a pretty common structure that affluent Aussies use, because it delivers a really good tax outcome, being able to distribute more of the income, and it also provides asset protection, through the trust, testamentary trust and company. One thing I didn't mention about the testamentary trust that's good as well is it's often described as ruling from the grave, because these parents then get ultimate discretion on how that money is used, and it can be kept in the trust. So it's good for when these kids grow up and get married. The family's money is protected because it stays with these beneficiaries of the children. So if these kids then get divorced, for instance, from their new partners, then the money still remains in this bloodline. So that's one example of the asset protection benefits there as well. With buying investments, you want to set up the structures first. Often we'll see clients who maybe bought 2 or 3 investment properties and then go, oh, we probably should have bought that in a trust. But then that's a little bit too late, because then to move it into a trust, you have to pay capital gains tax. So when you've got good income and you're on your way to being affluent, that's the time to reach out to a financial planner, see whether these structures are worthwhile for you, whether the benefits outweigh the costs. So if you need help with that, please reach out.